Hello, you're watching BiTV European Service. I'm Ines Bouget, and today I welcome Christopher Mertlitz, who is Managing Director and Head of European Investments at WP Carey. Hello, Christopher. Thank you for joining us.
Hi, Ines. Pleasure to be here. Thank you so much.
So WP Carey has acquired 3 casino assets for more than 102 million euros earlier this year. Why did you make such an investment?
It's a good question. Certainly for us, when we look at any transaction, there are several key attributes that we would like to find in a project. We'd like to make sure that we have long-term predictable cash flow as a result of that investment. We would like to be very comfortable with the mission criticality of these assets or the importance of these properties to that particular company. And we just want to make sure that all around we make, from a real estate, from a credit perspective, and from a risk reward perspective, a sound investment. And we identified these assets as meeting these criteria, specifically given that they were some of the best performing stores in the casino network. And we were able to structure a very interesting transaction from a lease term and lease structure characteristic regarding these properties. So there was a lot to like about these assets, and there was also a lot to like about the industry and the specific sector as well. And we've clearly seen food retail as one of the most stable and well protected elements of, quite frankly, the entire retail industry during the last few months, as COVID created certainly some very, very substantial dislocations in a range of other industries. So all in combined, from a pricing, structuring, and criticality of the assets perspective, it all made a well-rounded transaction. But I would not necessarily take this single investment in the retail space as the sole example of what we do, because fundamentally we invest across all of Europe and North America, and we invest across all commercial real estate asset classes. And we don't typically first ask or allocate, I should rather say, to a specific asset class. We really try to be very agnostic in that respect and look for good risk-adjusted returns and well predictable and long-term stable cash flow. So again, that's kind of some of the elements we liked about the deal, and which it's been working out very well so far.
Right, and how do you see large volume transaction evolving?
It's a good question. Large volume deals as such, they can be quite lumpy, and they can be, well, by the very definition, and it sometimes can be slightly misleading. If you look at any single quarter, you might see several large projects closing, and then you might see another quarter where they don't. It's just a function of how the market operates, and I would not necessarily read too much into it. But broadly speaking, I would expect the prevalence of larger volume portfolio transactions to increase, mainly driven by the large amount of capital that is currently seeking a home in the real estate world and is trying to be deployed into real estate. And in a way, it creates some degree of portfolio premium for larger projects, which makes it, from a seller's perspective, even more interesting to transact larger deals as well. And certainly from a buyer's perspective, it's always been more interesting to invest in larger volume projects, whether it's a large deal or small deal. At least from my perspective, we go through a very, very similar due diligence process. So naturally, larger volume deals are more interesting. But broadly speaking, the current environment, where there's so much money looking to find a home in real estate, I'd say that's even more true than it has been previously.
Right, and finally, I have one last question. According to you, what role would sale and leaseback deals play into the investment strategy?
Sure. I think it makes sense to maybe bifurcate that question. When you say it from an investment strategy, I'd say from our investment strategy as WP Carey, it's going to continue to play an enormous role. And fundamentally, we've been doing virtually nothing else but sale and leasebacks for the past 50 years. And that's kind of our bread and butter type of transaction, and really what we're best at and what we're best known for. Of course, we also work on build-to-suit projects, and we acquire other net lease single assets or portfolios. But sale and leaseback transactions, really, that's the core of our investment strategy. And first of all, I don't see any reason for that to change. And secondly, there's not even any kind of indication well, there's no reason we would need to change that. And it's been the mainstay of our investment philosophy for 5 decades. From a broader market perspective, I can also see more and more participants in that specific type of transaction entering the real estate investment market, and there's certainly more participants in that field. But in a way, that's a good thing, because the market itself is growing, and also the awareness of corporates to use sale and leasebacks as an innovative financing model is also increasing. So while there are more participants in the market working on structuring sale and leasebacks, in parallel also the market itself is growing. So I see net actually as a positive. And there's a lot of activity in that space. And certainly as we come out of this COVID-induced crisis, there certainly is a lot of demand by corporates to raise capital. And sale and leasebacks are one of the best ways for corporates to do that. So actually, I would expect the overall attractiveness of using real estate as a way to provide financing for companies to increase.
Christopher Mertlitz, thank you for joining us.
It's been a pleasure. Thank you so much for having me.
Thank you all for watching.